Hello, everybody. My name is Lush Eisner, and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record 2 videos per week, so make sure you ring the notification bell to get notified each time one comes out. This is my thoughts on market happenings for the week ending December 16th, 2022. Looking at the market indexes for the week, the TSX, S&P 500, Dow Jones, Nasdaq, and Russell 2000 were all down for the week, mostly from around midday Wednesday, when the U.S. central banker Jay Powell started speaking about interest rates and needing to keep increasing them. Gold and oil were up for the week, however. So looking at Canada, despite oil trending downwards recently, with China reopening, the US refilling its strategic oil reserve, and Europe needing all the energy it can get, the downside of oil prices is limited, and there's talk about $100 per barrel. Housing affordability is worse than ever in Canada as mortgages eat up almost 70% of disposable incomes. This hasn't been since 1980s. Only 30% of your income should go into housing, and of course, this is straining household finances. The Canadian non-mortgage debt jumped 7.3% in the 3 months ending September. Average owed is over 21,000. Credit card debt was up 17.3% year over year to an all-time high as well. The average debt owed by Canadians is 1.83 for each dollar of disposable income. Insolvencies are up 19% year over year for October. In Canada, about 3/4 of variable mortgages have fixed payments. When interest rates move, the amount of the mortgage payment does not change, but the portion going towards interest rather than principal is adjusted. But if interest rates increase substantially, these mortgage borrowers may reach a point where their fixed payments cover only interest and not any principal. The interest rate at which this happens is known as the trigger rate. If rates rise above the trigger rate, borrowers may then need to increase their mortgage payment to cover the additional amount of interest. For some households, this payment increase may be unexpected. Of borrowers with a variable rate fixed payment mortgage, this is an estimate of about 50%, or nearly 13% of all Canadian mortgages have already reached their trigger rate as of November. They may need to increase their payments or talk to their banks, and these mortgages are technically in default. This is bad news for Canadians, but note that banks may not mind and they'll just tack on the extra principal so the mortgage grows. In its outlook for Canada, the International Monetary Fund, IMF, sees a slowdown but not a recession for Canada. There'll be no negative GDP growth quarters, and unemployment might come up to 6%. The commodity exports have isolated us from the shocks because of the high commodity prices have supported the economy. The IMF also sees a 20% decrease in house prices and welcomes the correction for affordability. They expect a raised inflation rate above 2% until the end of 2024. The inflation will be at 4% at the end of 2023 because it takes time for the interest increases to work their way through the economy. Turning to the US, there were a couple of big events. The first was the US consumer price reading on Tuesday, which was lower than expected in all categories and should be generally positive as the inflation trends downwards. The market in the US took these results positively, expecting lower interest rates overall as a result. So the US core CPI month over month for November, the actual was 0.2%, while the forecast was 0.3% and previously was 0.3%. The core CPI, Consumer Price Index, year over year for November, the reading was 6.0%. The forecast was 6.1, and the previous month, year over year, was 6.3%. Looking at headline inflation for November, month over month, it went up just 0.1%. The expected was 0.3%, and the previous month was 0.4%. So definitely trending in the right direction. And the year over year for November was 7.1%, forecast 7.3, and the previous month was 7.7. So definitely heading in the right direction. This week's US CPI shows impressive disinflation levels, and that the market was looking for exactly this before the Fed rate decision. The peak inflation level has long ago passed. When you look at the data, it's hard to support the narrative that inflation is entrenched, and as inflation comes down, and there is hope that the US can escape a recession, avoid high unemployment, and maybe just have lower growth for a time. The second big event for the US was on Wednesday when the US Federal Reserve reinforced its inflation fight by raising its key interest rate 0.5% for the seventh time this year and signaling more hikes to come. That last part the stock market did not like, possibly because of the cautionary line of, quote, the committee anticipates that ongoing increases in the target range will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time, end quote. The US Fed doesn't want to revisit changing its price target at this time. But the Fed announced a smaller hike than it had in its past four meetings at a time when inflation is showing signs of slowing. The Fed boosted its benchmark rate half a point, as I mentioned, to a range of 4.25% to 4.5%, its highest level in 15 years. Though lower than its previous three-quarter point hikes, the latest move will further heighten the cost of many consumer and business loans and the risk of a recession. It's likely the terminal rate for the US interest is in the 5% range, either slightly below or above. Inflation has already seen its peak and is trending downwards, but it is lagging as it takes 6 to 18 months to affect inflation, depending on which expert you talk to. The markets are also pricing in rate cuts for the late 2023. Jay Powell said, quote, historical experience cautions strongly against prematurely loosening policy. I wouldn't see us considering rate cuts until the committee is confident that inflation is moving down to 2% in a sustained way, end quote, on Wednesday. This ruined the expectation of rate cuts. Only if the economy gets into trouble and a deep recession occurs would rate cuts be likely. Otherwise, the rates will stay higher for longer. That's been a theme. On the good news is that sales are tracking well in the US for the holiday season. And finally, turning to a little bit of science, US scientists were able to generate net positive energy using fusion. Anything commercially viable is at least a decade out, as always. The breakthrough was that they actually got 3 megajoules out when they put 2 megajoules into 192 lasers in a large installation. Each of those lasers is the most powerful on Earth. And finally, some bits and pieces. Microsoft is taking a 4% stake in the London Stock Exchange Group as part of a new 10-year partnership. Over that period, LSEG has agreed to spend at least $2.8 billion on Microsoft's cloud-related products. Microsoft will also move LSEG's data platform and other parts of its tech infrastructure to its Azure cloud product. The two firms will also work together on developing workplace collaboration tools. Oracle came in with a solid earnings report on Monday. The tech giant beat Wall Street's expectations on adjusted profits per share, while revenue grew 18% year over year to $12.28 billion, higher than the estimated $12.05 billion. Its margins also expanded. Oracle's cloud business provided a big boost too. Revenue from cloud services and license support rose 14%, while cloud infrastructure revenue surged 53%. It wasn't all rosy, though. Oracle offered earnings guidance for the current quarter that came in below analyst estimates. The European Central Bank raised its interest rates by 0.5% as well. And looking at China, China's reopening appears to be holding for now, but COVID infections have increased. Oil demand and therefore prices are expected to increase as China continues to reopen and consume energy. Looking at next week, we have the tail end of the Q3 reports. So on Tuesday, we have Nike reporting, giving an insight on the US consumer. We also have General Mills and FedEx, which is a look at the economy. On Wednesday, we have Micron, a memory chip company. Economic events for the week. On Tuesday is Canadian core retail sales. On Wednesday is the big item, Canadian Consumer Price Index, with a 6.6% year-over-year expected increase, down from 6.9% the previous month. And the US has related data to the oil industry. On Thursday, the US has GDP numbers, and on Friday, we have Canadian GDP numbers. So we get to see whether we are nearing zero. Next week is the beginning of the holiday season in Western countries, with lots of people not working, especially traders. Market volumes are typically lower during these 2 weeks, and small players can move the markets with small transactions. Market volatility can get quite a bit higher than usual in the last 2 weeks of 2022, so be aware of that. This concludes my thoughts for the week. If you have any requests on what you would like me to cover in future videos, please put that into the comment section. Please like, subscribe, ring the notification bell, and may you have a profitable day.